All right, so thank you again for joining the class this evening. Someone else also joined from iPhone.
I love them.
They match them perfectly.
They're like, I saw your.
All right, okay, so I'm going to share my screen and I will share my entire screen because I may be switching back and forth between different documents. Are you able to see my screen?
Yes.
Okay.
Yes.
All right, fantastic. So now let's go ahead and start our discussion. This is chapter 3, analysis of financial statements. Now, you might recall from our first class where we talked about the roles of accountants and finance managers and the CFOs, for example, specifically dealing with finance. I mentioned that preparing financial statements is the role of the accounts department. So what they do is that they collect financial information, accounting information, they record it, analyze it, record it, and then prepare the financial statements based on that information. Now, when those financial statements are prepared and when they are complete, then we jump on to do some financial analysis of the financial information of the financial statements. And that is where we jump into the finance role. So that is not, that's not the only thing we do in finance, but this is just one of the things we look into the financial statements to analyze the financial health of a company. All right, now, can somebody tell me what the different financial statements are? Just to have an idea, what are the different financial statements?
Oh, are you talking
Yes.
about the balance sheet and such?
Exactly. So balance sheet is one of the statements, correct? That's perfect. Any other statement that somebody can name here? How about income statement? Income statement is another statement that we prepare in accounting. There is a statement of cash flows. There's a statement of owner's equity. But we will primarily be looking into income statement and balance sheet in this class today. Now, once we understand the different elements in those financial statements, specifically the balance sheet and income statement, then we'll go ahead and conduct some ratio analysis. So ratio analysis is basically finding different ratios. And what is a ratio? Actually dividing one number by another number is a ratio. If you say if you calculate percentage, like what is the tax rate in the state? Okay, the sales tax rate in the state. All right, so whatever that is, 5%, 6%, that is basically the tax amount divided by 100, and that comes out to be 6%, for example. Now this 6% is a ratio because we divide one number by another number, but that gives us a better idea to understand the overall situation. So when we do ratio analysis, we will be basically conducting that, primarily dividing one number by another number, and that will make it more meaningful as compared to looking at the raw numbers. Okay. And then DuPont equation is basically an extension of the ratio analysis. So basically it combines a few ratios to make a better and in-depth analysis of the company. So we'll be looking into that. We'll spend a lot of the time on ratio analysis. All right. So what are the different financial statements? You already pointed out balance sheet. Yes, that is one of the statements. The first one that we normally talk about is the income statement. So can somebody tell me what we record on the income statement? Hey, Stephen. Thank you for joining. So that was you were the one joining from iPhone, right? Okay. So Steve, seems like his microphone is not connected. It doesn't show any microphone sign here. But anyway, income statement is a statement of financial information prepared by the accountants, where we record the net, the bottom line of the income statement is the net income. And how do we arrive at that net income? We start from the total sales information. How much sales did we make in that month or that year? And then we remove the different expenses, one expense and then another one. And at the end, we also remove taxes. And the final bottom line is what we call the net income. You might have heard about, we often talk about this bottom line in our discussion. So we say, what is the bottom line here? So the bottom line basically is that the income that we talk about. So starting from revenue, and then we remove different expenses, and at the end we come up with the net income. And net income is the money, the income that goes to the owner's pocket. Okay, that is the owner's earnings. So once we prepare the income statement, then we go ahead and prepare the balance sheet. So we can prepare the owner's statement of owner's equity before this, but we can also jump ahead and directly prepare the balance sheet here. Balance sheet is another statement of financial information, but we record a different set of information here. And what are those different sets of information? We record our assets of the business. So assets would include, if we have cash, that is our asset. If we have a building, if we have a car, any of those items that the business owns, and those have a future benefit for the company. So if you've got a building, of course, you own the building, and you've got a future benefit from that building. Remember, if you lease a building, you're still using the building, but it is not something that you own, so it will not be recorded as your asset on your balance sheet. Only those assets that you own, those items, okay? And they have a future benefit. We also record liabilities of the business on the balance sheet. So what is a liability? Can somebody tell me what we mean by a liability? When we that is something that we have to pay. It is a borrowed money that we have to pay. You've borrowed some money from the bank and you will pay it. That's a liability. Okay. If you purchased your inventory from your suppliers on credit, you will have to pay that back. So it's again a liability. And the third item that we note on the balance sheet is the owner's equity. And what we mean by that is the owner's investment in the business. Okay, owner's investment in the business. So there are three items that go to the balance sheet: the assets, liabilities, and owner's equity. And there's a famous equation that we write in accounting where we say that assets must be equal to the sum of liabilities and equity. So liabilities plus equity. Forgive me if the spelling is not right. Assets equals to liabilities and equity. That's not a minus sign, by the way. This is what we call the accounting equation. So when you prepare the balance sheet, your total assets must be equal to the sum of your liabilities and the owner's equity. If these two are not equal to each other, then there's a problem in our accounts, and we have to go back and look at what's wrong in our numbers. Okay. And that is why this particular sheet of information, of accounting information, is called balance sheet, because it has to be balanced. assets must be equal to liabilities and equity. If it is not balanced, then that is not a balance sheet. Okay, the next statement is the statement of owner's equity. This is basically a detailed account of this equity, the owner's money in the business. But when we write it down on the balance sheet, we just write it maybe in two numbers, or maybe just one number. We just write it owner's equity on the balance sheet, just one account. But where is it coming from? There will be different types of owner's equity. For example, how much did the owners invest initially? How much was invested in addition to the initial stock share price, okay? And how much money has the business retained from the owner's earnings? So all of that detail will be written in the statement of owner's equity. So it will be a little bit more detailed account of the equity. Okay, and the final statement is the cash flow statement. This is another sheet of information where we basically portray information that tells us about the cash flow of the business. Where is the cash of the business coming from, and where does the cash is going to? Okay, and if there are some loopholes, probably the cash is going into unnecessary or less important items. We will have to keep a control on that. And if we are going to have less cash, probably a shortage of cash in the future, we will have to plan for that. So this is another statement that we prepare. Now, in this particular course, we will primarily focus on income statement and balance sheet. Okay. So any questions so far? Hey, Marina. Thank you for joining. And we also have Kishan James. Thank you. All right, now here is a very oversimplified balance sheet of a company. Okay, so I mean, like it is for teaching purposes, a very simplified, very few accounts mentioned, but it will at least explain what a balance sheet is and what kind of information we note in a balance sheet. So as I said, there are two aspects, two sides of the balance sheet, and those two sides are basically the two sides of the equation. So on the one side, we write assets, and on the other side, we write liabilities and equity. So this sheet, this slide is the first side of the balance sheet. These are the assets of the company. Okay, and we have numbers for 2021 and 2022 that basically states that it is the estimated number because the 2022 has not ended yet, right? So these are the estimated number, but we can presume those are the numbers. Now, what assets do we have in this business at the moment? We have got cash, and that cash is $85,632. Look at the last year's number. We had only $7,282 in cash. Well, that is a very small amount of cash for a business that has a total assets of 2.86 million, 2.87 million almost. So if you have that much of a business and you're holding only 7,000 in cash, probably there is some issue and you will have to increase, you'll have to bump up your cash amount. Anyway, we're going to look into that in a minute. But right now, in 2022, we increase our cash to 85,000, which is good. Accounts receivable is the next asset that we have listed on our balance sheet. Now, accounts receivable is basically the money that is receivable to us. Okay, when we sell our inventory to our customers on credit, okay, let's say we've got a factory and we're producing lots of goods and we are selling to the retail stores. The normal arrangement with the retail stores is that they buy our inventory and they promise to pay us back in a month or 2 months, whatever that arrangement is. That is the normal course of business in those kinds of businesses. All right, so you will have an accounts receivable. If you sell $100,000 of inventory to a retail customer, okay, a retail client, and the client promises to pay you back in 2 months, then $100,000 is your accounts receivable. It is your asset, it is your money, but it is in your customer's pocket. So you will have to collect it later. And the sooner you collect that money, the smarter, maybe more efficient businessman you are. If your receivables stay with your customers for a long time, probably there's something wrong with your business operations, and you would have to look into the problems that might be there. Inventory is another asset. Now, inventory is the asset that we buy with the intention to resell it as a normal course of business. So if you are, let's say if you are a retail store, whatever you buy, the inventory, a grocery store, for example, the groceries that you buy, these are for resale purposes as a normal course of business, and those are what we call the inventories. Okay. However, if you've got a car for the business, for example, that is not your inventory because you don't intend to sell it as a normal course of business, even though you may have to resell it after a year or so, or maybe it breaks down, or you just don't like it and you sell it after a month or so, but it still does not count your inventory. The car does not count as your inventory because it is not your usual business. However, if you're a car dealer, then the cars that are there in your parking lot, which are for resale purpose, those cars is your inventory. Okay. Now, if we add all of these three assets, we get a total sum of $2,680,112, and that is the sum of the above three assets. We put these three assets in a separate category that we call the current assets. Now you can see there are two categories in the assets. One is the current assets, and the other category is the net fixed assets. Now, if I ask you, and I really need that input from anyone, even if that is not the correct answer, but just I want your engagement in the class. So, what do we mean by current assets? What is current asset? Anyone?
Usually current asset is referencing the asset for this fiscal year.
Perfect, Tasha. That is a perfect answer. Any asset that we intend to convert into another type of asset, or we intend to convert it into an expense within one financial year, that would be a current asset. If the asset stays with us for more than a year, then it would be a long-term asset. So very good, Tasha. Thank you. Now, just look at cash. If you got $100,000 cash, you don't intend to keep that cash for a year or 2 years or 3 years. You would like to use that cash. You're paying for expenses, you are buying inventory with that cash, you are paying salaries. So you are basically, circulating that cash. So it is a current asset. It doesn't stay for more than a year. Same goes for receivables, for example. If you have to receive some money from your customers, you don't want that to be staying in the customer's pocket for years. You would like to collect that as soon as possible. And same goes for inventories. You would like to sell it as soon as possible. All right. So those are what we call current assets. All right. Now, the next category would be long-term assets. There are a number of subcategories in the long-term assets, and one of those is fixed assets. So fixed assets, as the name indicates, these are assets that are physical in a more fixed existence. For example, a building, a factory, for example. Even your car, that is a moving asset, but it's like it has a strong physical existence. So that is also included in the fixed assets. All right. If you have, for example, a copyright or a patent that you have registered and it has a value, that is also a long-term asset, but it is not a fixed asset. That is what we call an intangible asset. All right. In this particular balance sheet, we have not included those intangible assets. We only talk about fixed assets. All right. And the term gross, what we mean by that is the gross amount that you paid to buy those assets. That is the gross value of the fixed assets. So in this particular case, for example, if we look at the 2022 number, that is almost 1.2 million, right? So $1.2 million of gross fixed assets. That means we paid about $1.2 million to buy those assets. And now we don't know the details for this particular business. There might be a building, 2 buildings, cars and factory, whatever, but that is what we have in the accounting information. Then you remove the depreciation from the gross fixed asset. What is depreciation? Anyone other than Tasha?
Can you hear me?
Oh, yes, Marina, I can hear you.
It's when something loses its value, and
Mhm.
it's not the same over time.
Correct. Okay, so that's a perfect answer. Whenever you have a fixed asset, it loses its, I mean, you can call it the wear and tear or the gradual degradation in the asset. For example, you've got a car and you use it. The more you drive it, the more it gets depreciated and the value goes down with that. Okay, so that is what we call depreciation. Same goes with the building. For example, the building gets used and it gets depreciated. So what we do is that we calculate the total depreciation of the fixed assets and we remove it from the gross value. So that means like 1.2 million minus 380,120. We find that difference and the final result would be the net fixed assets. So we remove the depreciation. This is the value of our assets on our balance sheet. The book value, this net fixed asset is what we also call the book value of our assets. Now, do remember, there is a difference between the market value and the book value. Okay, suppose that these assets, when we bought them like 10 years ago for 1.2 million, and these are all buildings, okay? What has the building values have gone up, depends on what kind of building you have. For example, if these are residential buildings, so the market value might be double or triple or maybe 4 times of this value as of now. But according to our books, the value is that. So this is the book value, the market value might be different. Okay, now the final item on this side of the balance sheet is total assets. So we have got 2 categories of assets: current assets that have a life of less than a year, okay, and net fixed assets, which have a life of more than a year. We sum these 2 up and we get a total of about 3.5 million in total assets.
I have a question.
Sure, Michael.
Michael Williams. What source document is utilized to actually gauge the depreciation of a building or a fixed asset? I'm a little confused.
Okay, that's a wonderful question, and it's more of an accounting side of the discussion. So it depends on the asset in particular. Let's say you've got a car. The best unit of depreciation would be mileage. The more you drive it, the more it gets depreciated. On the other hand, if you've got a building, so we don't drive the building, but with the passage of time, even if you don't use it, there the wear and tear, and so in that case, we would be using the number of years as depreciation. So let's say we say that the building will be completely depreciated in 100 years. and we bought the building for $100,000. So $1,000 is depreciated every year. So that would be a constant. Okay. If you got a machine that produces, like a factory, and you got machines that produces some products. So in that case, I would say that the number of units that the machine produces would be used as a unit for depreciation. The more units it produces, the more depreciation it causes. Got it? Thank you for asking that question. That's a wonderful question.
Yes, sir.
All right. Okay. Now, just to make sure that am I going too slow, or I don't exactly know where you are confused and what information is really necessary. So if you think that I'm going into unnecessary details and I have to move faster, then let me know, please. Okay, now we go to the next side of the balance sheet equation. Going back to the balance sheet equation, we talked about assets. And by now we know that we have two types of assets primarily, current assets and long-term assets. And we talked about those in our balance sheet. Now we go to the next side of the balance sheet, and that is liabilities and owner's equity. So let's go to liabilities and owner's equity part. Here you go, liabilities and owner's equity. Now, when we look at the liabilities, we again have a section which we call total current liabilities. Let me write that as current liabilities. Now, this concept is the same as current assets. These are the liabilities. This is what we have to pay to others. And these are going to be due within a year. So that's why we call them current liabilities. Okay. They will include, for example, accounts payable. So let me write that properly. Accounts payable. So this is when it's the same concept as accounts receivable, but accounts receivable is what we receive from our customers. Accounts payable is what we have to pay to our suppliers. So we also, as a business, we also buy on credit, and we tell our supplier, hey, you know what, I'll pay you in a month. So that amount is what we call accounts payable, and it's a liability. It's a current liability because it will be due in a month or two. So that's why we call this liability. Accruals is another current liability. Can somebody tell me what this is? If you tell me, I'll give you extra credit. I'll note that down. Accrual is a liability, but what it is? All right, okay, no problem. It is a liability, basically, that accrues with the passage of time. Okay. So it accrues with the passage of time. And it's a liability you have to pay. Just imagine, like, we are using electricity. Right now, when we're sitting in front of our computers, we're using electricity, right? And we're consuming it. So the meter is running, and we are accruing a liability with every second and every minute and every hour, right, as we consume it. And it is building up. But we will have to pay it after a month. So that is a liability that accrues, and we haven't paid it yet. Same goes for salaries, for example. If you've got 10 employees and they work with you on the first day of the month, you don't pay them on daily basis. You pay on monthly basis, for example, or bi-weekly basis. The first day that they worked for you, you haven't paid them yet, but they have accrued their wages. So it's our accrued liability. We owe them some money when they work for us for a day. And similarly, notes payable is like a short-term borrowing from a bank, short, or maybe a year or 6 months, or you just need some money quickly and you go to the bank and you borrow. Now, all of these, and there will be a number of other categories in the current liabilities as well, but we call them the current liabilities because they are due within a year. Okay, for example, your electricity bill, The company is not waiting for you, is not going to wait for you for a year or more or 2 years to pay the bill, right? If you don't pay for 2 months, they will disconnect your electricity, right? So you have to pay every month. That's a current liability. And then we have long-term debt. Now, that long-term debt is a long-term borrowing, maybe from a bank or from any other source. Like, for example, your mortgage is a long-term liability. You may have borrowed cash from a bank that is payable in 5 years. So that is also a long-term liability. We call them long-term because it's not due in a year. So these two, the long-term liability and the current liability, these are the total liabilities. So if I ask you what are the total liabilities, you will sum the current liabilities with the total long-term debt. That would be the total liability of the business. This is the amount of money that the business has to pay to its different types of creditors. Okay, then we come to the owner's equity. And owner's equity in this particular example has 2 elements. One is common stock. Common stock is the amount of money that our company received from its shareholders when we sold the shares to the shareholders the first time. Okay, so we sold whatever number of shares, okay, and we collected about 1.7 million, 1.72 million from the shareholders. That is what we call the common stock. Okay, then as we do the business earns money. Now, when we earn income, part of that income is paid to the shareholders as dividend. Okay, so they receive some cash flow, and part of that is retained by the business so that it can be reinvested and is used to make the business grow. So that is also added. It is still the owner's money, right? It is still the owner's money. We just earned it for the owners and we retained it in the business. So we add this common stock with the retained earnings, and the total sum is going to be total equity. That total equity is basically the owner's investment in the business. In this particular case, it's about 2 million, right? You can see that number, about 2 million investment by the owners. Okay, if you want to find the total liability plus equity, then you will add this equity with the current liability, which is this number, plus the long-term liability, which is that number. It will come out to be a total liability. Make sense? All right. Okay, so I have also put this for you in an Excel sheet. I just quickly did that, so the format may not be too good, but here's the balance sheet, and these are the same current assets that we talked about, and this is the sum of the total assets. So what we can do is we can write a formula equals to SUM sum of these 3 cells, right? We close the parentheses and we get that number as we got earlier, right? Similarly, we have got gross fixed assets and we got depreciation. So in order to get the net fixed assets value, we write equal, we take the gross fixed asset value minus the accumulated depreciation, which is 380,120. We press the enter button and we get the net fixed assets value. In order to get the total assets would be equal to the total current assets, which is that number, plus the net fixed assets, which is $817,040. So we add those 2 numbers and we get the total fixed assets, total assets. All right. On the liability and equity side, the total current liabilities would be equal to the sum of these 3 liability accounts. So we can write down equal to sum of these 3 liabilities. We close the bracket and we got that number. Okay. Then we have got long-term debt, we got that, and we have common stock and retained earnings. The total equity would be the sum of the common stock and the retained earnings. So we simply write that down, equals to the common stock plus the retained earnings. All right, we got the total equity. Now the total liability and equity would be equal to the total equity, which is this number, plus the total current assets, which is that number, plus the total long-term debt, which is the 400,000. And we press enter. Now we have got all these numbers through our formulas. Okay. Now, if we look at the total liabilities and equity, and we compare that with the total assets, do we have the same numbers? You see, the total assets are about 3.497 million 152. Okay, and that is the same number as we got here. That is why we call this sheet as a balance sheet, because the two numbers have to be balanced. Is that clear? All right. Now, let's move on to the next slide to talk about the income statement. Now, as I said earlier, the income statement is a statement where we write down the revenues and expenses. And we simply remove the expenses from the revenue in order to get the net income value. So sales is what we call, sometimes we call this revenue, sometimes we call it sales, but this is the amount of money that you collected when you sold your products to your customers over a year, for example, because in this case, this is a 1 year income statement. So in 1 year, you sold $6.9 million worth of total products, and you collected this money. Now, what expenses did you incur on this? One of the expenses, what we call the cost of goods sold, cost of goods sold. This expense is basically the direct expense of the goods that we sold. So for example, if you are a grocery store and you sold a total grocery of 6.9 million, that is what you received from your customers. But the cost of that grocery was 5.875 million, for example. That is what we call this is what you paid to buy the groceries. So that is the cost of goods sold. Okay. And then you had some other expenses. So it could be, let's say, marketing expenses, rent and salaries and stuff like that. So we have a very oversimplified income statement in this case. So that number for other expenses is 550,000, right? Now, when we remove these two expenses, the cost of goods sold and the other expenses, these are what we call the operating expenses of the business. Operating expenses of the business. We remove these two numbers from the sales, we get these numbers. Okay, that is what we call EBITDA. EBITDA basically stands for earnings before interest, taxes, depreciation, and amortization. It means that this is earnings. We have earnings of this much, but we still have to remove interest expense from this earning. We also have to remove taxes from that number. Okay, we also have to remove depreciation expense from that number. And if there's any amortization, we will also have to remove that. Amortization is basically depreciation, but it is for intangible assets. Like you have a copyright. Okay, that copyright also has a certain life and it depreciates. Okay, so we call that depreciation as amortization. Okay, so it's pretty much the same concept, but used slightly differently. If you have natural resources, for example, you've got an oil well and you're drilling it and you're pulling out oil from the well, then there's a certain limited number of oil barrels of oil in that well as per the estimate, and as you pull it out, you are basically decreasing the value. And that is what we call depletion of natural resources, depletion. So it's pretty much the same concept as depreciation or amortization, but depreciation is used for fixed assets, amortization is used for intangible assets, and depletion is used for natural assets. Okay. Now, so if this number is before interest, taxes, depreciation, and amortization, then let's start removing one by one. So first we remove depreciation and amortization. So depreciation and amortization for this particular year is $116,960. If we remove that from EBITDA, so basically EBITDA minus depreciation and amortization, we get this number. You see, we have that same thing, but we just removed depreciation and amortization. So we are left with EBIT. Okay, BA is no more here. Depreciation and amortization has been removed. And this EBIT, EBIT, which is called earnings before interest and taxes, this is often also called operating profit. Operating profit. So if you hear operating profit in the state, the question has given you EBIT, that means it's the same thing. And why do we call this operating profit? Because we made this number, this profit is a result of our operations. Okay. Now, then we remove the interest expense, okay, which is $70,000 in this case, $70,008. This is now a financing expense. This is not an operating expense. And when we remove that, we get EBT. You see the I is also removed now, EBT, earnings before taxes. Now what is left? Taxes are still left. These have to be removed. So then we calculate our taxes, which is in this case, $31,866. We remove that from EBT and we get the net income. So that net income is the bottom line, and this is the earnings for the owners. Okay. Now, if the owners decide to take all of that money out of the business and use it for personal use, then there will be nothing added to retained earnings. But if the owners on the other side decide that, okay, we earned this money, but we're not going to take it out because we need to expand the business, and let's keep it in the business so that we can expand it, then this 255,774 will be added to the retained earnings account on the balance sheet. You see this retained earnings account, it will be added over here. All right. Whatever, I mean, it's the owner's money, so they can decide, well, okay, we'll retain 100,000 and take out the rest, whatever they decide, maybe 50-50 or maybe whatever. You're the owner and you decided. So now we have just just finished decomposing the two financial statements, balance sheet and income statement. Let's go to the Excel sheet and see how we get those numbers on the income statement. So it is the same income statement as we discussed over there. We have sales, we have cost of goods sold, which is the direct cost of the goods that we sold, and then we have other expenses. This number, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, it will be equal to, we write it down, equal to revenue minus the cost of goods sold and minus other expenses. So we get EBITDA. Then we write down depreciation and amortization, and EBIT will be equal to the EBITDA minus amortization and depreciation and amortization. So we get that number. Then we calculate our interest expense, okay? And when we remove that interest expense from EBIT, we will take EBIT minus interest expense, we get the EBT, earnings before taxes. And then we calculate our taxes. Depends on what percentage of taxes we use, we calculate, it will be a percentage of the EBT. But anyway, in this case, we have got a straight number. So then we remove the taxes. So the final income will be equal to EBT minus taxes, and you get 255,774 is the net income. Got it? All
Yes.
right. Okay. Now, let's move on. And so here's some additional information about the same company that we're talking about, that we discussed the balance sheet and income statement for. This company has 250,000 shares. Last year, the shares were 100,000, but this year they have issued some more shares, so 250,000. Earnings per share, EPS stands for earnings per share. So this number basically comes from the earnings, which is net income divided by the number of shares. Net income divided by the number of shares. That means the company earned $1.023 for each share of the shareholders. Last year, if you look at that number, the EPS was a negative number, which means that the company lost $1.6 for each share of the shareholders. So if you were holding, let's say, 100 shares of this company last year, you lost 1.6 for each share. You multiply that with 100, that means you lost $160 last year. Make sense? And DPS stands for dividends per share. Dividend is basically the money that the company pays to the shareholders. Okay, so for each shareholder, last year they paid 11 cents to each shareholder, and this year they plan to pay 22 cents to each shareholder. Okay. Now here's a question, if somebody can answer me, so it's a little, interesting. Their earnings per share was a negative number, which means they lost money last year, but they still paid dividend. Now, how do we explain that? In the current year, they earned $1.23 for each shareholder, for each share. So if they pay 22 cents, 1.0, no, not $1 in $1.023. If they pay out 22 cents to each shareholder, they still can pay it from the earnings, right? But in this year, they had a negative earning. How can they pay a dividend?
This is a shot in the dark, but the graph doesn't necessarily reflect the earnings per share in the year of 2020. So there may have been some residual income from that previous year that probably transferred over to 2021 to make up for the loss.
Perfect. That's a perfect explanation. And if we go back to the balance sheet, for example, like, last year, the company had retained earnings of 32,592. So even though the income was negative, they still had some retained earnings from the previous years, as you said, maybe from 2020 or the early years. So they can use this money to still pay the shareholders a little bit of money. And why do they pay it? Because the dividend is a cash flow that each shareholder is just looking forward to. If I have invested in a company and my expectation is that I have got, like, let's say 10,000 shares in a company, or 100,000 shares in a company, and I expect that I'll be receiving like 10 cents a share in dividend on a certain date. And all of a sudden, if the company decides, hey, we're not going to pay any dividend, I'll be broke because, I have planned something for that money. That cash flow is coming and I have planned. So shareholders will be disappointed if the company does not pay the dividend. So in order to keep the shareholders still satisfied, at least with their cash flow stream, they still pay it from the retained earnings. Sometimes, even if the company does not have any retained earnings, they will borrow some money from a bank and still pay a dividend to the shareholders, even though that will not be a wise thing to do, but it can sometimes happen just to keep the expectations of cash flows of the shareholders. Thank you. That was a perfect explanation, Michael. All right. And then stock price. So this is the market price of the company's share. Okay, $2.25 last year, and this year they expect it to be $12.7. And lease payments, 40,000 last time and 40,000 this year. So okay, that's the additional information we're going to use to do our calculations. Okay. Now, moving forward, why do we do ratio analysis? Okay. So if I ask you this question, that there are two companies, company A and company B, for example, let me see. Okay. Okay, there are two companies, A and B, and their net income for company A, basically I need 3 columns. Okay, so A and B, and then we write down net income. Company A earned 100,000 in net income, and company B earned 500,000 in net income. Which company is good? A or B? A earned 100,000, B earned 500,000.
It's all relative. This is Stephen, professor, but it could be relative to the operational expenses and the budget they had going into the years. So while one appears on the surface to have a larger profit margin or income, it does not nearly mean once you do your calculations that they're going to come out on top.
Exactly. That's a wonderful answer. And so that means it's relative. This information is not sufficient to say that what one company is better than the other. We have to look into the other accounts of the income. So let's say we also look at the assets of the two businesses. This company has 200,000 in total assets. And this company has 2 million in total assets. Now you might be in a better position to say which company is performing better. Now, in this case, the net income is like almost 50% of the total assets. In this company B case, the net income is only 25% of the total assets. So you can say that company A is earning a return on assets of 50%, ROA, return on assets for company A is 50%, right? And for company B, that is the income is only 25%. Correct me if I'm wrong. Is that 25%? Yes, I think so. So 25%. Now, this, when we convert this earning into a percentage of assets, that is a ratio, and it gives us much more information. It makes it easier for us to decide which company might be better. So on the surface, by looking at just one ratio, it appears that company A is much better than company B, even though its income was only 100,000 as compared to the 500,000 of company B. But efficiency-wise, company A is much better. Again, we cannot decide with absolute truth that, hey, by looking at just one ratio that company A is better. We have to look into other ratios and other information to establish with probably more certainty which company is better. Okay. That's just one example to understand how ratios can make the analysis more simplified. That's why we conduct the ratio analysis. Now, when we calculate these ratios, we also have to compare these ratios with the industry averages. So if I am earning like 25% return on assets, what is my competitors doing, right? How much are they earning? If my competitors are earning 40% and I'm earning 25%, I'm not good. But if I'm doing better than the industry average, then that might be a good sign. Similarly, we will also have to do a benchmark analysis. What that means is that we find our closest competitor and we compare our ratios with that competitor to make it, more relevant, right? We might be in a grocery store business. Okay, Walmart is also a grocery store business, but we cannot compare our ratios with Walmart if we are just running a small grocery store, right? However, I can compare my numbers with a neighboring store in the same area doing the same business. So that will be a benchmark or peer analysis. Okay. And similarly, we do a trend analysis. Trend analysis is looking at our previous ratios, like what was our return on assets like 5 years ago, and then 4 years ago or 3 years ago. Are we improving? Are we going up? So that would be a good sign. Are we going down? That would be a bad sign, right? So that would be a trend analysis to look at as well. So we find each ratio, we compare it with the industry average. We would also like to compare it with our closest competitors to see how we're going as compared to that competitor. And we also look at our own trend. Are we improving with the passage of time, or are we going back? Okay, so that is what we are going to do in the ratio analysis. Okay, now moving further, we are going to look into a number of ratios categories. So there are different ratios categories that we can talk about. Let's discuss this slide, and then we will end the class today. We'll continue our discussion next week. Okay. So the first category is the liquidity ratios. I misspelled that. That's ratios. Okay. Liquidity basically is the availability of cash to meet your liabilities. So these ratios basically look into how liquid your business is and whether you would be able to meet your short-term obligations or not. Okay, so we simply compare our current assets with our current liabilities to see our financial position. We may have a lot of assets and everything, but if we run out of cash and we're unable to pay our liabilities, we can go bankrupt despite of having good profitability. The next category is what we call the asset management ratios or activity ratios. So the names are used interchangeably, sometimes asset management or activity ratios. These ratios basically measure how efficient we are in our operations. Okay. We'll talk about these later on. The next category is debt management ratio. These ratios basically look into the amount of debt in our company. How much debt and equity do we have? What is the percentage? How much interest are we earning? How much is our income as compared to our interest expense? And we'll see how what those different ratios mean and how can we make sense of them. The next category is profitability ratios. We look into whether we are making any profit or not. Are we profitable or not? So one of that would be profit margin, return on equity, return on assets. This is just one of the ratios that we just looked at, right? Return on assets. It's that simple, nothing complicated, right? Very simple thing. Same goes for return on equity. We simply take the net income and divide it by the total owner's equity and get a number. And same goes for the other. So it's nothing complicated here. And the last one would be market value ratios, which is one of them is the price earning ratio and market value to book value ratios. So we'll also look into that. Now let's end the class here, because when we next time when we go to each of these ratios, we will go to our financial statements and actually do calculate the ratios and see what those are. So that you can understand it better. Do you agree?
Yes.
All right, thank you. Any question? Or any
Yes, I have a
suggestion?
quick question.
Oh, sure. Who is this?
Thank you so much. This is Natasha. I'm sorry.
Tasha, okay, yeah.
Yeah, thank you so much for doing this. I really appreciate this. I was curious, is this going to be every Wednesday that we're meeting live?
Yes, every Wednesday. Do you recommend, I mean, if the whole class prefers a different time, I'm okay with that.
Okay, I was just curious.
All right, so yeah, that's the plan. Even like it's the evening time, you're tired and I'm also tired. I had the first session, if you remember, I had it in the morning, but there were some students like, you're all working and everybody's at work and probably,
Yeah, I do remember that.
not convenient. So I changed it to evening, so that we can have more participation. But otherwise, if you prefer in the morning, I would love that, because we're more energetic in the morning.
Okay, I mean, I'm good either way. I just wanted to just know how to
All right.
plan my schedule.
Sure, appreciate it. Okay, so we will meet next week, Wednesday, same time. We'll continue the same chapter. All right. In the meantime, if there's any question, I'm just one email away. All right.
Thank you. Have a good evening, everyone.
Thank you. Have
All right,
a good
thank you
evening,
again so
Michael,
much.
Stephen, Marina, Tasha, and we have Veronica. Thank you, everyone, for joining today. Take
Y'all
care and
be
have a good
safe.
evening.
Have
You
a
too.
good
Bye-bye.
night. Bye.
Thank you. Bye.